Let's say the tax bill is $100,000. Would you rather pay the $100,000 now, or would you rather pay the $100,000 in 5 years? I would rather have a tax or an interest-free loan from the government for 5 years. Defer is an important word over save, because we're not saving taxes. We're simply pushing this into the future. There's something called recapture. Mitchell, do you want to explain briefly what recapture is and what that means?
This is a tax deferral strategy. We are trying to kick the can down the road, which
interest-free. I've heard you mention the word interest-free loan from the government.
Yeah. So this idea of, if I buy a property today, so you bought this $50 million of storage and you got this $12.5 million upfront of bonus depreciation. The other thing is you didn't pay $50 million for that property. You took some debt on that, right? You took 60% leverage on it.
We took about $20 million of cash.
Okay, so 20 million of cash, bought 50 million of property to year one, get 12.5 million of bonus depreciation. So the year the cash leaves your bank account to go buy the property, the deduction comes to match that year. So this happens in other areas of the tax code. This happens in a 401k, right? If you put money into a 401k, the cash leaves your bank account, you get a deduction that year. And then 70 years later, when the cash comes back, you pay tax, right? Well, we're doing the same thing here, except I don't have to wait till I'm 59 and a half. First of all, I may not get a one-to-one benefit. In your case, you paid $20 million to get 12 million of depreciation. Shoot, it helps, but certain asset classes or certain particular deals you could pay, or if you put enough leverage on it, or the way that it works, you could put 20 million down to buy $50 million of property to get $40 million of bonus depreciation.
Tell me about the hold period. People want to know, how long do I need to hold a property for it to make sense? And what does recapture mean? And when does recapture hit me? And how does that work?
So again, this tax savings that you get year one, presumably you're raising debt and you're raising capital. If not other people's capital, it's your own capital. This capital has a value, it has a hurdle rate, especially when the risk-free rate is 5% out there today. So we don't even really talk about hurdle rates when we sell these cost studies, but it's become more and more important because you're going to have to raise this money from somewhere. So we need to ascribe a value over time. So what you get by pushing the tax down the road and freeing up that tax capital to instead, or that the taxes you would pay now go into your project or are available for you to go buy a jet ski.
To explain in simpler terms, I think the value cash capital is what fuels real estate. Real estate is tough to get into for so many reasons because it requires so much cash. Even buying a house, a single family rental for $100,000 is going to take $20,000. Not very many people have $20,000 lying around. Cash is the lifeblood and cash is valuable. Right now, you put $100,000 or $1 million in an account, you're going to get $4,500 or $45,000 a year just from T-bills, right? So cash is valuable. So if we can have a tax bill that will be due to us, we're going to have a tax bill that's due to us at some point, whether it's now or whether we sell a property in the future and we pay recapture, we're going to have a tax bill. Let's say the tax bill is $100,000. Would you rather pay the $100,000 now, or would you rather pay the $100,000 in 5 years? I would rather have a tax or an interest-free loan from the government for 5 years. But tell us what happens when you sell. Let's say we bought $1 million property, we've depreciated it down by 25% over 3 or 5 years. It's got $750,000 of basis left, and we sell it. And let's say we sell it for not 1 million, but 1.5 million. Let's just run through some basic numbers there. I hate public math. I'm putting you on the spot, but let's say we deducted 250,000. And then we made an extra 500,000 on top of that. So we're 750,000 above our basis. How does the tax break down, and where does recapture?
Sure. So the most you could recapture is just kind of back to $1 million. And the worst case scenario is you just essentially think, well, I'm going to just pay recapture on everything. So let's just set that as the benchmark. I mean, realistically, like if you bought a used property with a 2-year-old fridge in it and you sell that same property with a 7-year-old fridge in it, like you bought it, like the refrigerator did not lose all of its value over 5 years. Somehow it still works even after 5 years. So you almost run this cost segregation at the end when you go sell it to revalue everything, but that's not really economical. So just you're almost going to pro rata that sale price across the original asset. Of course, some of the short life property would be less valuable, and hopefully the land would be more valuable. And to the extent that happens, you can mitigate recapture. But just assuming you're going to pay recapture, all of the short life property that you took bonus on that didn't live out its life, you're going to have ordinary income recapture on it. And some of the long life property, the 39 or 27, as it were, that you deducted that you're going to recapture on, you're going to pay 25%. So
Okay.
You're going to pay ordinary income. And
so we're
you're
using
pay
that we're using that $250,000 deduction to save us, 37 or 40%, whatever our regular income tax bracket is. So if we deducted 250,000, 40% of that's about almost $100,000.
Yep.
And then when we go to sell, let's just to make it simple, we sold it for $1 million and we didn't do the cost seg on the way out. We had $250,000 of recapture because we had depreciated it, and now it's recapture.
Yep.
That then 5 years from now is going to be deducted at an
tax
ordinary.
That a lot of ordinary income, a lot of 25%. And then, back to the $1.5 million example, the 500 of actual capital gain is going to just be capital gains rates.
Yeah. Okay.
So
if we ignore the capital gains on top, we're going to pay that even if we don't do cost segregation. That $250,000 of bonus that had lowered our basis in a property, that's going to be taxed at ordinary income, but it's saving ordinary income tax rates at the beginning if we're a real estate professional.
The worst case recapture is that, again, you just have to pay back exactly what you saved, but it's 7 years later. And you can't forget, Nick, like you get all these outs. You have 1031s, you have opportunity zones, you die and step up basis. Like real estate, it may not always be this flexible, but today it's pretty flexible. So all you're doing is when money goes out the door, saving tax, when money comes back in the door, paying tax, and buying a ton of optionality.
And people don't talk about the fact that it's way easier to pay tax when you're liquidating assets and making money anyway. It's harder to pay tax in the year that, hey, I'm outlaying $250,000 to buy a property, and I'm also paying tax that year. Okay, that sucks. But if I'm making a $500,000 nut on a profit on a property that I sold, it's a little bit easier to pay the taxes then at that point. So what would you say? Like, it's really the only risk here is the cost of the study, right? So if you're going to hold it for 2 years, if your payback, we can do some case studies on what the payback ratio is on a cost seg. But if you're going to hold a property for 2 or more years and you'd rather not pay tax this year and you're okay to pay it when you sell, it kind of makes sense to do a study.
Big news, guys. I created a free PDF that details my method on how I analyze a self-storage facility and figure out what it's worth. Give me a pen, the back of a napkin, and a couple metrics, and I can figure out about what the property is going to be worth to me. If you want to download this PDF, click in the show notes, the first link, and you can give me your email address, and you get a email right away with a 4-page PDF that outlines exactly how I think about underwriting or giving my initial analysis on a self-storage facility. Again, click the link in the show notes, and you're going to get that document for free. This episode of The Nick Huber Show is brought to you by RE CostSeg. If you want to maximize your bonus depreciation and minimize your tax liability, make sure to do a cost segregation study on real estate you've recently acquired. RE CostSeg offers the lowest priced, fully engineered studies in the business, and you get a virtual site visit with a quick turnaround. They did 30 plus cost seg studies for me over the past year, including a short-term rental, along with my self-storage facilities. And I'm also an investor in the business, along with my good friend and CPA, Mitchell Baldridge, who you all know. To learn more about how bonus depreciation works, listen to episode 75 of The Nick Huber Show, or visit recostseg.com to go ahead and get a free proposal that outlines the cost of the study and your potential savings. Thanks again, recostseg.com.